Hi, everyone. So, thank you for coming to hear our panel today on multi-strategy investing in digital assets. My name is Vladimir. I represent Quonota Investments, where we run both venture strategy focused on crypto projects, focusing on the seed and Series A stages, as well as a liquid strategy focused on yield from the crypto space and digital asset space. So we'd like to kick off with a short introduction from my fellow panelists. Guys, if you can maybe start with a minute on your kind of your background and the background of your companies. Maybe Katy, I know you have a background both on the sales and the buy side, so maybe we'll start with you, and then we'll take it from there.
Sure, sounds good. Hi, guys, I'm Katy Allen. As Vlad mentioned, I straddle the buy side and the sell side. I've been in the markets almost 20 years. I began my career in foreign exchange, doing institutional sales for about a decade for UBS, Bank of America. Then I retired and ran my own tech startup for 7 years. And I came into crypto about 4 years ago, which I think is a good intersection of currencies and tech startup. So it's a good fit for me. Focused on institutional sales at a crypto trading firm called Blockfills. And about 6 months or so ago, I moved over to the buy side. Blockfills launched an asset management business in December. So now I'm running biz dev for Cerus Digital, the asset management arm of Blockfills, raising for a market neutral fund.
Right. Yeah, hi everybody. My name is Brett Lyons. I'm the co-CIO and co-founder of an asset management company, VenHedge. We are a multi-strategy fund of funds, so we invest in about 30 different fund managers across asset classes. So traditional asset classes such as public and private equity. We have a traditional hedge fund portfolio, and then we have a digital asset crypto fund of funds, which specifically has about a dozen fund managers in it.
Hi everyone, I'm Alfonso Delgado. I run a digital assets hedge fund called Silver 8 Capital. We're a US firm, but most of the team is actually based in London. And we've been around for 9 years, so I think we were one of the first hedge funds to start allocating to this space. We have a strategy that combines research for asset selection with quantitative models for risk management. And hopefully today I can share some insights on this market, how we've seen different trends come and go, and comments on institutional adoption as well over the 9 years that we've been trading this market.
Thank you, guys. Thanks for the introduction. So, a number of different strategies here, from what I hear. Maybe you could comment on the current landscape where you see for current investors looking to get an allocation to the digital asset sector. What are the most prominent and interesting strategies out there right now, and why? What are the benefits of those?
Sure, I can kick us off. So I have a unique perspective, having been at a trading firm and now at a hedge fund. I would say my time in Blockfills, we have seen a lot of fundamental discretionary long funds launching, and those kinds of strategies have been really popular, I would say, kind of in the last 6 months or so, leading up to the bull market run in crypto. Now, I'm at a market neutral fund, so I have to talk my book here for a minute. It's been very choppy leading up to the bull run, so to speak. And I like having a market neutral strategy in a diversified portfolio just to sort of battle test the downside. It's been very choppy. We had Black Monday. So I think, market neutral isn't the sexiest strategy right now, but crypto is super volatile and it's not straight line up and to the right. So I would say we're a little bit differentiated than some of the popular strategies out there right now.
Yeah, totally. I'd echo that. I think we've always thought that the best diversification in crypto is diversification across different strategies. I mean, you can take a diversified portfolio of crypto assets, but there are idiosyncratic factors that affect different crypto assets. But, at the end of the day, the correlations between these assets are all quite high. So we actually started as a crypto hedge fund back in 2017. We managed the money ourselves. At the time, we were running only one strategy, long only crypto. So we kind of saw firsthand the importance of diversification, the volatility of running one strategy, particularly when it's unhedged, both up and down. So we kind of came out of that 17-18 cycle, like, how are we going to prevent this type of drawdown from ever happening again? And, what we came up with was diversification across strategies. And, we see it in traditional markets. There's a whole spectrum of really interesting strategies to allocate to. So on the fully hedged side, market neutral type strategies that Katy was talking about, various types of arbitrage, so statistical arbitrage, basis, market making, and then kind of going up to semi-hedged strategies, systematic trend following. I mean, any asset that has a price can be trend followed. You can probably speak to that. So that's more like quantitative systematic, and then we also allocate to discretionary strategies as well. So semi-hedged, crypto long short strategies. They tend to have some long bias in there, and then up to long only and venture.
I think you really have a diverse fund landscape. You have fundamental funds that are focused on finding the next few tokens that might do really well based on trends that are ongoing in the industry. So fundamental, you have non-directional funds that are really trying to exploit frictions in the market. We tend to see more fund launches when the basis comes up because there's more opportunity to trade that and get some yield. Also, when DeFi was hot, we saw a lot of fund launches around that. So the market neutral, non-directional guys tend to be very opportunistic. And I think the past year or so has generally been good for those guys because even though they're non-directional, you tend to see a lot more frictions arise and last during bull markets because participants focus more on price rather than relative value propositions. So non-directional space is very strong. You have the liquid venture guys, again, which has some overlap with fundamental because you're investing in venture propositions. They're very early stage tokens, but you suddenly have liquidity. So it's different to traditional venture capital with a closed-ended fund with a 10-year life. Here you have a bit more optionality to exit your investments earlier on. That has some overlap with fundamental liquid strategies as well on the hedge fund side. Where we position ourselves is more on the what we call quantamentals. So we think there's value in researching the asset class to find up-and-coming trends, assets that we think will appreciate over a medium-term horizon, but combining that with models that we have seen deployed successfully in other asset classes that we think can add value to control risk in our asset class. Because when you invest in this market, you're dealing with very high volatility, very high drawdowns. And I think we've seen a lot of demand for structures or products that can really try to mitigate those risks for investors that believe in the industry potential, but don't want to stomach that level of risk.
Brett, maybe a question for you coming from a fund-of-fund side of things, because we mentioned a number of strategies now. You guys running a fund-of-fund strategy, how do you, maybe you can say a couple of words, how do you get to the optimal kind of allocation in terms of the different funds and the different strategies? What is your approach there?
Yeah, I mean, I think it starts at the manager level. Like traditional fund of funds investing, I mean, it's nice to have a portfolio of different strategies. You try to fill out the different buckets. But at the same time, probably even more important to think about the managers and kind of start at the manager level. So, just really looking for experienced, great managers. I mean, crypto hasn't been around that long. So, the track records don't go back that far. So it doesn't, have to necessarily have a long track record, but, other parts of these managers that demonstrate an ability to execute on the strategy that they're trying to pursue, have a robust operating environment. But yeah, I mean, I think, and then when you diversify across managers, you sort of inherently get diversification across strategies at the same time. I mean, we allocate to some managers that you can say, okay, that they are both discretionary long bias managers. But when you put two long bias managers together, you end up seeing some dispersion and differentiation just because it's different management styles. And of course, there's lots of great teams out there that are more market neutral and fully hedged and focusing on trend and market making and whatnot. So, obviously those are completely different risk return profiles than long oriented fundamental strategies. So, I think, once you get to a certain number, you start to get a lot of inherent diversification.
Cool. Thank you. So we discussed now a couple of the benefits and the fundamentals behind these strategies. Can we talk maybe a little bit about the limitations? Because especially if we're talking about maybe market neutral or more systematic strategies, there certainly are some limitations in terms of, for example, liquidity or capacity and scalability of these strategies. How do you guys deal with that, and what is your approach?
Sure, I'll take that. So we actually have a multi-strat approach to our market neutral fund because, as you mentioned, there are liquidity and capacity constraints, especially with arbitrage type strategies. There are arbitrage opportunities because liquidity isn't great and the market isn't as efficient as, say, an FX market, for example. As you get bigger positions and the market gets more liquid, then those arbitrage opportunities narrow. So in addition to sort of arb market making traditional strategies, we have a futures trading strategy where we look for kinks in the yield curve, and we trade around fair value. So in the futures market, you have greater liquidity. So that's one way that we increase capacity in our fund. And then we have a stat arb strategy that's like a long short dollar strategy that endeavors to be dollar neutral and can go long or short Bitcoin and ETH based on the signals in the fund. And there's more capacity in that. So as we grow our AUM, we tweak sort of the allocations to those three strategies based on, what the strategies can hold capacity-wise. But in general, not even just for market neutral, liquidity is an issue in crypto. And, some of the liquid token funds and these discretionary long funds have issues too. Building out a sizable position in an altcoin takes weeks or months even. So liquidity is always at a premium for crypto.
Just to add to that, what we've seen following the launch of the ETFs in the US for Bitcoin and ETH now is that the difference in liquidity between those assets and the long tail of altcoins is exacerbated now. So it is easier now, perhaps a year ago, to trade Bitcoin and ETH in size. But if you're trying to get altcoin liquidity, it really is a struggle. And it also depends on how much risk you want to take on with your counterparties, because if you want to stay within regulated pools, maybe you're trading with public companies, if you're more conservative like we are, you're not going to access the same level of liquidity than if you are happy to go offshore and trade in unregulated venues. So there's often a trade-off in terms of the risk factors that you take on, in terms of the liquidity pools that you decide to trade with. But I would say that the gap between Bitcoin and ETH and the rest is exacerbated in recent months.
And would you say that the recent approval by the SEC of the BlackRock options on the ETF, how do you think that will impact your strategies and the industry in general?
Well, we don't trade, we're not incorporating ETFs into our strategy, but in general, the more products, the more participation, the more liquidity, the better for the market in general. So I'm bullish. I love those signals. I love the adoption.
Nice.
I'm really hopeful those options on the ETF will help the option market to grow because it's still relatively nascent. Deribit is the largest options venue by far. They have maybe 90% of the volume. But it really is still a pretty small market. So if you want to run an options-based strategy, I was having this conversation with a market maker recently. They think that you would be able to run maybe 50 to 100 million. That would be your max capacity in their view. And if you're running a fund of that size, it's very hard to be institutional. It's very hard to take capital from large asset management firms, pension funds, you name it. It's hard. So I really think there's a lot of opportunity for the market to grow. And I think that that product will hopefully contribute towards that.
Yeah, and just to add to that, I think, I mean, options are great risk management products. In traditional hedge funds, they're commonly used by hedge funds to kind of overlay and get downside convexity onto the market. And so opening up a regulated option exchange on the ETF products in the United States is gonna, I think, open the doors. It's just another tool in the toolkit for managers to kind of dial in the exact amount of risk that they want at any given time.
Okay, clear. But we mentioned market makers now, and one question I had was, maybe if we can start once again, Brett, with you. When you look at the different funds, I mean, obviously, especially I think the situation is better now, but in the past cycle, counterparty and credit risk was a big theme. Is that something you focus on when picking funds, when you do the due diligence on the funds that you invest in? And then guys, Alfonso and Katy, maybe you can cover as well how your firms kind of try and tackle that risk.
Yeah, I mean, we definitely look at funds. Maybe like prior to FTX, I remember looking at quite a few funds that would run on only one counterparty. I mean, funds that run options only strategies, have really been only able to operate on Deribit. So, from a fund of funds perspective, we can allocate to a manager that is concentrated in one counterparty, just because we're running a diversified portfolio, so it can be diversified at the portfolio level. But I mean, that's as a fund of funds investor. I mean, any one fund that is investing all of their capital entirely in one counterparty is quite risky. Would not recommend that. I think post FTX, we definitely see managers thinking a lot more about how to manage credit risk and counterparty risk across the space, including not only the managers but also the industry. I think there's been a big push for the industry to have more transparency onto the reserves that are backing different exchanges, and just genuinely, I see the industry trying to repair itself after the FTX blow up, which is a very great thing to see.
Yeah, crypto definitely has a trust issue that we are slowly rebuilding after FTX. And it's been interesting for me, just coming from the foreign exchange markets, like the KYC really goes both ways. It used to be sitting at UBS, who is this client? Let's put them through the ringer. And it's, it goes both ways in crypto. Hedge funds are putting trading firms through the ringer and vice versa. I think that's really healthy and good. Like you said earlier about the management teams, you can't just look at a balance sheet of a company anymore to predict the stability of the company. I love working for a company where, our head of options is 58 years old and he was a partner at Goldman Sachs, and he's been through the financial crisis and whatnot. And having a management team that's conservative and understands risks is very important. Now, to get into the nitty gritty of like Cerus and how we're thinking about risks, we use solutions like Hidden Road, for example, to ensure our funds on exchange. We try not to keep funds on exchange. We call home our assets every night and basically only leave on exchange what we need to for operational purposes. So yeah, those are some of the things that we think about when mitigating risk.
I think what's really important in this space is that you can have the risk of extreme losses, not only from market risk, meaning drawdowns, losses in price, but also from blowouts from counterparties or technical issues, as we saw with Luna. So it's important to take that into account when you think about risk factors of having exposure to digital assets. Because if you're not careful enough, if you're not diligent, if you're not doing KYC on your counterparties, as Katy was saying, there's a chance that you will be taking on risk that you're not aware of. So it's about understanding the risk, making sure you're being compensated adequately for the risk you're taking on. And for us, we take on enough market risk as it is because we have a long bias strategy. We decided from inception not to layer that with credit risk and technical risk on top, which is why we've been relatively conservative. We only trade with public companies, as I mentioned. That's helped us over the years to be able to bypass many of the issues the industry has seen. We invest in a more mature segment of the market, so typically the top 15 by market cap. So we do a lot of technical due diligence to make sure that we understand the protocols that we're exposed to, the value proposition, the verticals for growth. So there's risk factors that you don't often think of in other asset classes that are very pronounced in digital assets, I would say.
Absolutely. And you know, all of you guys have been in the industry for a number of years, and you know, as we've seen the industry evolve, so have the strategies and kind of more the strategies that are prominent currently or more successful. However, we have, as in your case, Alfonso and Brett, like you mentioned, for you guys, the strategies have evolved, and you know, which is a bit different to the traditional space, where you know, if you start a fund, you know, you have to stick quite rigorously to the rules out there, not to the rules, but to kind of the investment mandate. As it seems that in crypto, and if we're talking about multi-strategy investing, flexibility is quite important. Could you comment on that a little bit?
Yeah, I think especially for discretionary managers, I mean, it's interesting. I mean, we've seen some discretionary managers who've left their investment program quite broad. They can invest across asset classes, different instrument types. They have the flexibility to go from 0 to 100 and back down, and you know, we see managers who have very strict investment programs that, you know, on the discretionary side, that, you know, say it's exactly half hedged at almost all times, and they rebalance pretty quickly to that if it deviates. I mean, I think, I mean, crypto, these markets evolve so fast. I mean, the market regimes changed so fast, you know, week by week, month by month. I think I've seen managers have success leaving, having flexibility and you know, utilizing that flexibility. I mean, at the same time, maybe you can speak more to the market neutral side. I mean, you know, those are pretty cut and dry strategies, right? I mean, you have your bread and butter, and you know, there's not. Anyway, I'll let you speak to that.
Yeah, I would say there isn't a ton of wiggle room in market neutral, but there are trades, basis trades, for example, different trades that become available depending on what's going on in the market. Obviously, the basis trade blowout was pretty awesome a few months ago, and that's come in quite a bit. And I'll speak to this as well, but we had demand from some of our clients to offer a Bitcoin fund, for example. Blockfills has a large presence in the mining space, a lot of miners, and that was sort of the genesis of Blockfills' derivative trading business, was preaching hedging to Bitcoin miners. And so we've seen a lot of demand for ways to earn yield on a core long position in Bitcoin, especially now with Bitcoin kind of retesting the highs. You know, what can we do to earn some yield on our core long without selling it and reinvesting it somewhere else? So we launched in June a Bitcoin share class for our fund. So you invest in kind, statements are in kind. And so that's been like a change that we have, we've met demand with the market, and we've been asked by investors to do it for ETH and Solana. So, you know, who knows? But that's some of the things that we have done to kind of change with the markets and address changes in the markets.
Maybe just to add from my perspective, when we started in 2015, you really didn't have tools to manage risk actively. You didn't have liquidity. You didn't have derivatives that you could rely on. You didn't have data to build models. So back then we had a more liquid fundamental version of our strategy. But to Brett's point, our documentation was fairly flexible in terms of what we could do, the instruments we could trade, because we knew that we were very early on into the market, and we could see that we didn't know exactly how, but we saw that this would mature over time and grow, and new financial instruments would come into play. We would have more data, we would have derivatives, and we would be able to iterate on our strategy to become more like traditional hedge funds, which is where we are today and where we've been for the past 40 years, where we try to use models and some of these tools like derivatives and data to protect the portfolio during difficult times and make sure that we're mitigating losses for investors. So there's certainly been an evolution as the market has matured for us. And I think key to adapting your strategy is not only the flexible documentation, but also communicating with investors, making sure that they understand the changes you're making to the portfolio, that they see the value proposition, and they still are comfortable with the profile of your product.
Communication's definitely, and a big deal for crypto. We're all about transparency and communication. We do like a monthly, email to investors saying, we're now trading with this exchange, and this strategy did well, and this one didn't do as well, and this one outperformed, and this is how our AUM is changing, and these are some of the decisions we've made. And it's important, I think, to have that kind of communication with investors.
Yeah. And we spoke a lot about Bitcoin, obviously, but I guess everybody in the audience is also interested. We have a lot of projects here at the conference, that we have a lot of tokens and projects out there. Are your firms looking, at trading assets further down the pecking order, so not just blue chips, let's say, not just Bitcoin and Ethereum, but are you looking at launching new products focusing on the altcoin market? Or, Brett, is your fund of funds also looking at funds that focus just on altcoins rather than BTC and ETH?
Yeah, we have one. I mean, we have several managers that go pretty far out the risk curve and trade altcoins. I mean, it's an interesting risk return profile. The kind of liquid venture long only style of investing is definitely kind of one piece of the mosaic, so to speak, for us. I think it's also I would say can be somewhat of a crowded space. There's lots of managers that are kind of trying to play these assets on the long side, and I think just really understanding the risk return profile, because the returns can be extraordinary, and the risk can also be it is also extraordinary.
We don't go down the tail. Liquidity is paramount for us, so we stick with our spot ARB opportunities just to the top 10 liquid tokens, and that mix will change, and we will change with it.
We're similar to Katy. We're really focused on the more mature segment of the market, so top 15, because that allows us to trade actively and make sure that we can get out of the market when we need to without having to pay very big spreads or running into other liquidity issues. So we're on the more conservative, mature side of the market as well.
Okay, cool. And now we're coming slowly to the end of the panel. Maybe just some final remarks from you guys of, what you expect the market to go, at least for multi-strat funds, into year end, and how you see the market for the next 6 months.
I'm bullish despite being at a market neutral fund. But as I mentioned, I think it's a great thing to have in the mix to weather those downturns that you get on the way to the top. So I'm bullish. I'm looking forward to having some post-election trading happening, clarity, getting some of these high-pressure events sort of out of the way. But I'm bullish overall the landscape, and rising tides lift all ships. So.
Yeah, I mean, I'm optimistic too. I always hesitate to give directional calls on the market. I think probably we're going to see a different type of market going forward than what we've seen in the past. So I think people should kind of prepare to have a different market environment than what we've seen in the past. And generally, we're diversification maximalists. I mean, and that's the fund of funds approach. We think multiple managers, multiple strategies is a great way to go.
I really think that the ETF launches in the US have established this as an asset class. You have BlackRock and Fidelity backing this and using their marketing capabilities to really push this to investors and make a case for this being part of institutional portfolios. So I really think that that was a pivotal moment for our industry on the asset management and investing side of things. I also think that the rhetoric at the government level, we're seeing that in the US, is a game changer, because if we go back a few years, we couldn't even think about a presidential candidate thinking of creating a strategic reserve holding Bitcoin. So just the fact that that's on the table and being discussed is completely game changer, because most likely other governments will start to have similar discussions in central banks, and that creates a really interesting room for strategies to grow and institutionals to become more allocated over time. So I'm very positive in the long run. Short term will be driven by our models, which we see as our strength. So it's hard to give short-term directional views for us.
Great. Great to hear that everybody sounds positive. Thank you very much for joining me, and I hope everybody enjoyed that. So thank you very much.